In today's financial markets, where information overload and market noise dominate our screens, there exists a profound truth that Richard Wyckoff discovered decades ago. The market never lies. While analysts, experts, and tipsters constantly share their opinions, often conflicting and frequently wrong, the market itself, in its ceaseless motion, tells the absolute truth to those willing to listen. Has this ever happened to you? You followed what seemed like solid advice from a respected source, only to watch your position move against you almost immediately. Have you ever wondered why so many traders lose money in a market that supposedly offers endless opportunities? What if I told you that the secret to consistent profits has nothing to do with complex strategies or insider information, but instead relies on understanding a language that never lies? The challenge isn't that the markets are unpredictable, it's that most traders aren't reading the right signals. Wyckoff understood that beneath the chaos of daily price movements lies a beautiful pattern of human behavior that repeats with astonishing regularity. These patterns, driven by the eternal cycle of fear and greed, make market movements far more predictable than most believe possible. Stay with me until the end, because understanding this principle alone could transform your trading results forever. But before we begin, please hit the like button and let me know where in the world you're watching from today. It's always fascinating seeing who's joining us from around the world. And if you haven't already, make sure to hit that subscribe button and turn on the notification bell so you don't miss any of our future videos. What separates the consistently profitable few from the struggling masses isn't access to better information. It's their ability to interpret what the market is actually telling them through price action. Think about it. Every transaction, every shift in supply and demand, every moment of accumulation or distribution is faithfully recorded on the charts for anyone with the patience and training to see. And that brings us to perhaps the most challenging yet rewarding principle in trading: patience. In a world obsessed with instant gratification, the market ruthlessly punishes impatience. While most traders treat the market like a casino, craving the adrenaline rush of constant action, the disciplined trader waits. What you're about to discover might surprise you. The best traders often do nothing for extended periods, only striking when conditions are perfect. Consider how often you felt the urge to enter a trade simply because you were bored or feared missing out. The market doesn't reward this behavior, it exploits it. True trading skill is demonstrated by resisting the almost irresistible human tendency to jump in after a stock has already made its big move, when everyone is talking about it, when the crowd is rushing in excitedly. The wisdom of Wyckoff's approach lies in understanding that success comes not from predicting the future, but from reading the present correctly. When you learn to see what the market is telling you rather than imposing your hopes and fears upon it, you begin to notice something extraordinary happening in your trading results. If you want more trading insights like these, hit that subscribe button and join our community of disciplined traders committed to mastering the market. You begin to notice a transformation in how you perceive market movements. What once seemed random now reveals itself as structured. The chaos gives way to order, and suddenly you're seeing the hidden patterns that were always there. Now, I want to go even deeper into this topic by exploring perhaps the most challenging psychological hurdle every trader must overcome. We've all heard the adage, cut your losses quickly and let your profits run. These simple words represent the foundation of successful trading, yet they're astonishingly difficult to follow in practice. Why? Because they run counter to our most basic human instincts. The human mind has a remarkable aversion to admitting mistakes. There's something about closing a position at a loss that feels like a personal failure, a blow to our ego and self-image. So instead, we hold on, hoping the market will eventually prove us right. It's just a temporary setback, we tell ourselves. It will come back. This mindset, this resistance to accepting small defeats, is precisely what transforms manageable losses into devastating blows to your trading account. Contrast this with how we handle winning positions. There's a peculiar satisfaction in taking a quick profit, isn't there? That dopamine hit when you close a trade for a modest gain feels like a victory. You can tell yourself, "I was right," and move on with a sense of accomplishment. But this momentary gratification comes at an enormous cost. It systematically cuts short the very positions that could deliver life-changing returns. The market reveals a profound truth here. It doesn't reward hope or wishful thinking. It rewards discipline and emotional control. The journey toward trading mastery isn't about developing more complex strategies. It's about developing the inner strength to act against your natural impulses. The predictability in trading comes from doing exactly the opposite of what most traders instinctively do. A simple revelation with powerful implications. This principle connects directly to another fundamental truth. Prices move in trends. The line of least resistance in any market is the prevailing trend, and aligning yourself with that direction is always the safest and most profitable course of action. Behind the scenes of every major market fortune lies this uncomplicated decision. Identify the trend and position yourself accordingly. Yet look around at what most traders actually do. They fight trends relentlessly, attempting to pick exact tops and bottoms. Convinced they can outsmart the market's momentum. They want to be clever rather than rich, to prove their analytical prowess by calling turning points. This battle against the market's natural flow is a primary reason why so many trading accounts diminish over time. The hidden truth is that great wealth in markets comes not from predicting reversals, but from having the patience and conviction to ride powerful trends until they show genuine signs of exhaustion. This requires surrendering the ego's desire to be right about exact timing and instead embracing the humility to follow what the market is clearly showing you. These principles represent a fundamental shift in how you approach the markets. Not as a battlefield where you impose your will, but as a flowing river where you align yourself with the current's natural direction. If these ideas resonate with your trading experience, write in the comments, "The trend is my friend," and share which of these principles has been the most challenging for you to implement consistently. When we truly embrace the current's direction rather than fighting against it, we begin to appreciate another profound revelation in Wyckoff's teachings. The price action itself is your only reliable compass in the markets. While the world obsesses over headlines, analyst opinions, and social media noise, successful traders understand that these are merely distractions from the only signal that matters, what the market itself is telling you through its price movements. Think about the last time you made a trading decision based on a news event or analyst recommendation. How often did the market move in the expected direction? The uncomfortable truth is that by the time information reaches you, it's already been priced in by those who move markets. The journey toward trading mastery requires a fundamental mindset shift, moving away from narrative-driven decisions and toward an open-minded observation of what's actually happening in the price. The market communicates through a language of supply and demand, fear and greed, all of which are faithfully recorded in the pricing data available to everyone. Behind the scenes of successful trading operations lies this simple philosophy: follow the money flow rather than the storylines. When a stock refuses to fall on negative news, that resilience tells you more than a dozen analyst reports. When a market collapses despite positive headlines, that weakness reveals the true underlying condition. This perspective leads us to perhaps the most illuminating discovery in market psychology. Human nature never changes. The great illusion that traps so many traders is the belief that each market cycle is fundamentally different. that this time is different because of technology, politics, or some other contemporary factor. But this is a mirage that vanishes upon closer examination. While companies and market participants constantly change, the underlying play remains exactly the same. An eternal struggle between hope and fear, between weak hands and strong, between the impulsive many and the disciplined few. Chart formations, price reactions, and breakout patterns we see today are essentially identical to those from decades ago because they represent the footprints of crowd behavior that never evolves. This revelation has profound implications for your decision-making process. It means that studying historical market cycles isn't just an academic exercise. It's practical wisdom that applies directly to today's trading environment. The emotions that drove panic selling in 1929 are identical to those that drove selling in 2008 and 2020. The greed that fueled speculative bubbles throughout history operates on the same psychological principles that drive today's market manias. For the observant trader, this consistency offers an extraordinary advantage. When you recognize that markets are simply reflecting the same human emotions that have always existed, you gain perspective that the crowd lacks. You begin to see patterns forming before others notice them. You develop the confidence to act when others hesitate and the discipline to stand aside when others are consumed by either fear or greed. This timeless understanding of market psychology represents the hidden truth that separates consistently profitable traders from the constantly struggling masses. If you've experienced moments where you recognized a pattern unfolding that you've seen before, type "history repeats" in the comments and share a specific market pattern you've noticed occurring repeatedly over time. When we recognize these recurring patterns throughout market history, we unlock a powerful perspective on where genuine trading opportunities emerge. One of the most illuminating revelations on your trading journey is understanding the role the general public plays in creating predictable, exploitable market conditions. Consider the typical market advance. As prices climb higher, media coverage intensifies, success stories proliferate, and suddenly everyone from your neighbor to your barber is discussing their latest stock purchases. This escalating public participation is actually a warning sign rather than confirmation. What we're witnessing behind the scenes is the final stage of a market cycle, the moment when the last potential buyer has finally decided to enter, leaving nobody left to push prices higher. The fascinating paradox is that the public's enthusiasm peaks precisely when opportunity diminishes. By the time investment ideas reach mainstream conversation, the smart money, those disciplined operators with genuine market insight, have already established their positions at much lower prices and are now quietly distributing their holdings to eager latecomers. Even more revealing is what happens during market declines. As prices fall, the same public that bought with excitement now sells with despair. Headlines turn negative, panic. Spreads and perfectly good assets are abandoned at irrational prices. Yet this capitulation creates the very soil from which the next opportunity grows. While the masses are proclaiming that the financial world is ending, strong hands are quietly accumulating quality positions at bargain prices. This enduring cycle of human weakness, greed at tops and fear at bottoms, creates predictable patterns that the disciplined trader can recognize and exploit. The mindset transformation comes when you stop following the crowd and start observing it as a market indicator. Now, I want to go even deeper into this topic by addressing perhaps the most crucial element of trading success. Despite what countless books, courses, and gurus suggest, consistent profitability isn't about brilliance, academic degrees, or mastering complex theoretical frameworks. The hidden truth that few discuss is that trading excellence stems fundamentally from self-mastery. The greatest challenge in trading isn't intellectual, it's psychological. It's not about finding the perfect indicator or strategy, but rather developing the ability to wait patiently, observe market conditions objectively, recognize established patterns, and act decisively only when the odds are genuinely in your favor. This disciplined approach stands in stark contrast to the impulsive, emotional trading that characterizes most market participants. The uncomfortable reality is that most traders, even those with exceptional analytical skills, cannot maintain discipline when their own money is at stake, when emotions are shouting in your ears, when fear and greed are pulling you in opposite directions. Theoretical knowledge provides little protection. Only those who have developed genuine emotional resilience can execute their trading plans consistently, regardless of market conditions. This journey towards self-mastery represents the true battleground of trading. It's an internal struggle rather than an external one, a continuous process of refining your decision-making under uncertainty and pressure. If you've experienced the challenge of maintaining discipline during volatile market conditions, type "Master Yourself First" in the comments and share one specific emotional challenge you're working to overcome in your trading. Subscribe now to access more powerful trading principles that have stood the test of time. I'm sharing these strategies to help you become the trader you're meant to be. This internal struggle to master our emotions reveals one of the most counterintuitive aspects of successful trading, a principle that stands in direct opposition to what most market participants believe. The revelation that transformed Wyckoff's approach to markets was simple yet profound. Sitting is more profitable than trading. In a financial culture that celebrates activity, that equates busyness with productivity, this wisdom feels almost heretical. Yet Wyckoff observed that the greatest profits come not from constant movement, but from strategic patience. His famous declaration captures this perfectly. "It was never my thinking that made big money for me. It was always my sitting." Consider the enlightening paradox here. The hardest work in trading is often doing nothing. The discipline to remain still while opportunity ripens, the restraint to preserve capital during unfavorable conditions, the patience to wait for perfect alignment before committing resources. These qualities separate the consistently profitable few from the perpetually struggling many. The untold story behind virtually every trading fortune is not a sequence of brilliant decisions, but rather long periods of watchful waiting, punctuated by occasional moments of decisive action. This paradigm shift in how we view trading activity represents a fundamental transformation in approach, from the frenetic energy of the gambler to the calculated patience of the professional. Behind the scenes of your own trading journey, how often have you felt that restless itch to place a trade simply because you couldn't tolerate inactivity? The ability to sit through boredom while others grow increasingly restless represents one of the rarest and most valuable skills you can develop as a market participant. Now, I want to go even deeper into this topic by exploring the natural rhythm that governs all market movements. One of the most illuminating principles in Wyckoff's framework is understanding that every action in the market creates a corresponding reaction. This isn't mystical thinking, but rather a practical recognition of how supply and demand interact within any financial instrument. Consider what happens after a stock advances swiftly. It must inevitably pull back. This isn't random, but rather the natural consequence of early buyers taking profits and new participants questioning whether they've missed the move. What's truly revealing, however, is how the stock reacts during this pullback phase. The character of this reaction provides critical insight into the underlying strength or weakness of the movement. When a stock experiences only shallow reactions followed by renewed upward momentum, it signals powerful buying interest, absorbing any selling pressure, a harbinger of continued strength. Conversely, when recoveries appear labored and struggle to regain prior levels, It often indicates distribution taking place, a warning sign for the attentive trader. The mindset breakthrough comes when you recognize these action-reaction sequences not as random fluctuations, but as meaningful conversations between buyers and sellers. The market is constantly revealing its intentions through these movements for anyone willing to observe patiently and interpret accurately. While the rules governing these patterns are remarkably clear, applying them successfully requires both careful observation and the courage to act decisively when the evidence accumulates. Have you noticed how your best trades often come when you recognize these action-reaction patterns unfolding? If you've experienced the power of patience in your own trading journey, type "sitting tight" in the comments and share how developing patience has impacted your trading results. Understanding these action-reaction patterns naturally leads us to another transformative insight in Wyckoff's approach: the recognition that genuine wealth creation in markets comes from participating in major movements rather than chasing small fluctuations. This perspective shift represents a fundamental departure from how most people approach trading. Consider the typical trader's journey: constantly entering and exiting positions, celebrating small gains, fixating on daily price movements, and ultimately wondering why their account fails to grow substantially despite constant activity. The hidden truth is that the pursuit of small, frequent profits often prevents participation in the life-changing moves that occasionally emerge in markets. The revelation that changed my own relationship with markets was realizing that the vast majority of trading profits come from a surprisingly small number of positions. Those rare occasions when you identify a genuine trend early, size your position appropriately, and, most challenging of all, stay with the movement through its full development. These opportunities represent the real pathway to transformative results. Traders who spend their careers scalping for small gains effectively work for the bucket shop, capturing minor fluctuations while missing the profound wealth creation that comes from riding complete market cycles. This distinction underscores the fundamental difference between speculation and gambling. The speculator doesn't need constant action or daily wins. Instead, they patiently build positions when the odds are overwhelmingly favorable and maintain those positions as long as conditions remain supportive. Behind the scenes of every great market fortune lies this simple truth: it wasn't created through hundreds of small, profitable trades, but rather through a handful of substantial positions held with conviction through major market movements. This perspective doesn't diminish the importance of risk management, but rather emphasizes positioning yourself to capture outsized returns when genuine opportunities emerge. Now, I want to go even deeper into this topic by addressing what might be the most challenging psychological aspect of successful trading. While most people assume that courage represents the greatest test of a trader's character, the willingness to risk capital and take positions, Wyckoff discovered a far more demanding requirement: patience. The profound insight here is that courage is needed only in brief moments of decision, while patience is demanded constantly throughout the trading journey. The real battleground isn't taking positions, but rather waiting. Sometimes, for extended periods, for perfect conditions to emerge. This waiting period represents the crucible that tests a trader's discipline, resolve, and emotional stability. Even more challenging, patience remains essential even after entering a position. Holding through inevitable reactions and setbacks while a trend develops fully requires extraordinary emotional resilience. Most traders sabotage their results by exiting promising positions prematurely, unable to endure the psychological pressure of watching unrealized profits fluctuate or temporary reversals threaten their confidence. The mindset revolution occurs when you recognize that this waiting, before, during, and sometimes after trades, represents the true work of trading. The decision moments themselves are relatively straightforward when preceded by proper preparation. It's the patience to allow opportunities to ripen fully and the fortitude to stay with positions through their complete development that separates extraordinary results from mediocrity. If you've experienced the challenge of maintaining patience during your own market journey, write in the comments, "Patience pays," and share a specific instance when patience, or lack thereof, significantly impacted your trading results. This balance of patience and decisive action connects directly to another dimension of market mastery: the ability to recognize the critical phases of accumulation and distribution that precede every significant market move. The enlightening discovery that transformed my own trading was realizing that major market operators always leave footprints visible in the tape for those trained to recognize them. Consider the hidden reality of market movements. They don't begin randomly, but rather through the deliberate action of knowledgeable participants positioning themselves before the crowd becomes aware. When large operators buy or sell, they cannot fully conceal their activities despite their best efforts. The deceit evidence appears in price action, volume characteristics, and subtle movements that seem insignificant to untrained eyes, but reveal powerful insights to the observant trader. The transformation in your trading results begins when you shift from following headlines, opinions, and rumors to studying these authentic footprints of supply and demand. Behind the scenes of every significant market move lies a trail of evidence, visible in the relationship between price and volume, in the character of reactions, in the structure of consolidations, that telegraphs the intentions of those driving the market's direction. Learning to recognize these footprints provides an edge that no tip, analysis, or news report can ever match. The ability to identify nascent trends before they become obvious to the general public. This represents the authentic language of the market, speaking directly to those patient enough to listen and skilled enough to interpret. Now, I want to go even deeper into this topic by examining how strong market operators actually behave. One of the most illuminating revelations in Wyckoff's approach is understanding that smart money moves quietly, deliberately, and often contrary to public perception. Their actions follow predictable patterns that create exploitable opportunities for the prepared trader. Accumulation, the process of building positions, happens silently over weeks or even months as strong hands systematically absorb stock from weak, impatient holders. During these periods, price often drifts sideways within a relatively narrow range, causing the public to lose interest or become frustrated with the apparent lack of opportunity. Yet beneath this seemingly dull surface, persistent support on declines and the stock's refusal to break down represent telltale signs of powerful buying interest. The journey of awareness continues when you understand the opposite process, distribution, which occurs when those same informed operators begin selling their accumulated positions. This typically happens during periods of apparent strength when positive news abounds and the public's enthusiasm peaks. The skilled operators methodically feed their holdings into this demand, selling into strength while the eager public believes the advance will continue indefinitely. The profound mindset shift occurs when you recognize these processes not as abstract concepts, but as visible, repeating patterns that unfold in real time on your screens. Every day, accumulation and distribution are taking place across different time frames and different instruments, creating the very foundation for future market movements before they become obvious to the majority. If you've ever noticed a stock that seemed unusually resilient during market weakness, or one that struggled to advance despite positive news, you've likely witnessed these processes in action. Type, "I see the footprints" in the comments if you've experienced that moment of clarity, when you recognized accumulation or distribution unfolding before a significant market move. Understanding these patterns of accumulation and distribution reveals the fundamental mechanism that drives all market movements, the timeless principles of supply and demand. This revelation represents perhaps the most clarifying lens through which to view price action, stripping away complexity and focusing on the essential forces that determine market direction. Consider what actually happens during the accumulation phase we just explored. As strong hands systematically absorb available stock, they're effectively removing supply from the marketplace. This process continues quietly, often for extended periods, until the floating supply, shares available for purchase, becomes significantly reduced. The breakthrough moment comes when new demand enters the market but finds limited supply available. The result is inevitably sharp, sometimes dramatic price increases as buyers must bid increasingly higher to acquire shares. This same principle operates in reverse during distribution. When stock is methodically fed to an eager public during periods of enthusiasm, the available supply steadily increases. The weak hands who acquire these shares lack the conviction, capital, or perspective to hold through adversity. When demand eventually weakens, as it always does after periods of excess, prices decline sharply, precisely because too much stock resides in these fragile hands. The illumination comes when you recognize that this supply-demand dynamic represents the authentic engine of market movements. Not news, not opinions, not predictions. The journey toward trading mastery involves developing the ability to assess this balance accurately through careful observation of price and volume behavior rather than narrative or sentiment. Now, I want to go even deeper into this topic by addressing perhaps the most dangerous trap that ensnares otherwise intelligent traders: the seductive allure of tips and rumors. One of Wyckoff's most powerful insights was recognizing that market gossip represents poison to effective decision-making, consistently leading traders away from rather than toward profitable opportunities. The uncomfortable truth is that the market doesn't respond to tips. It responds solely to the actual balance of supply and demand, which is faithfully recorded in the tape for anyone willing to study it objectively. Yet most participants perpetually seek shortcuts, believing that someone else possesses special knowledge that will provide easy profits without the discipline of proper analysis. The transformation in your trading results begins when you recognize that tips and rumors primarily serve the interests of those providing them rather than those receiving them. By the time information reaches you through these channels, the smart money has already positioned accordingly, either buying before good news becomes public or selling before negative developments emerge. Even more concerning is the psychological impact of tip-dependent trading. Those who rely on external guidance gradually surrender their judgment and self-reliance, waiting for others to tell them what to do, rather than developing their own capacity for market analysis. This dependency creates a perpetual disadvantage, positioning you permanently behind those making independent decisions based on direct observation. The revelation that changed my relationship with markets was understanding that genuine edge comes not from access to supposed inside information, but from superior interpretation of information available to everyone. The tape, the record of actual transactions, tells the truth without bias or agenda, while gossip consistently misleads even when well-intentioned. If you've experienced the disappointment of acting on what seemed like valuable information only to have the market move against you, type "trust the tape" in the comments and share how you've worked to become more self-reliant in your trading decisions rather than depending on external guidance. As we've explored these timeless principles from Richard Wyckoff, I hope you've recognized something profound: that the market has been speaking the same language for over a century. The patterns, the psychology, the footprints of smart money, they remain consistent despite the ever-changing landscape of technology and financial instruments. What truly separates successful traders from the struggling masses isn't access to better information or more sophisticated tools, but rather the patience to observe, the discipline to wait, and the courage to act decisively when genuine opportunity presents itself. The market rewards those who take the time to understand its language rather than those who simply react to noise. If these ideas have resonated with you, if you found yourself nodding along as we've discussed the principles that transformed Wyckoff's trading, and potentially yours, I'd love to hear from you. Type "The Market Speaks" in the comments if you've made it to the end, and share which principle discussed today might have the biggest impact on your trading approach. This conversation is part of an ongoing journey toward trading mastery. If you found value in these insights, consider subscribing to join us as we continue exploring the timeless wisdom that creates consistent results in an inconsistent market. And if this conversation has added something meaningful to your trading perspective, a like helps others discover these same principles. I've prepared a video that builds directly on these concepts, showing exactly how to identify these accumulation and distribution patterns on actual charts. It's the perfect next step in applying what we've discussed today. Click right here and let's continue the exploration of how the market reveals its intentions to those patient enough to listen.